Hi, and welcome to Kuvera QuickTakes. We are speaking with Mr. Ajay Tyagi today. Ajay joins us from UTI Mutual Fund. He's been with us before. Hi, Ajay. Thank you for joining us.
Hi, Neelabh.
So, Ajay, quickly jumping into the question straight away. So, we often get a lot of investors coming to us and ask us that I've had a windfall in the sense that they receive money as bonus or they sold property, so they have some surplus cash sitting in their bank account. And the question is that should this money be invested into mutual funds through an SIP or by way of a lump sum? So should I invest it as a one-time investment or spread it out over the next 12 months or whatever?
Sure. Yeah, I think it's a very valid question, and many of our investors ask us about the same. So let me just break it up into two parts: SIP versus lump sum. What do we recommend insofar as SIPs are concerned? We typically say that most investors would have a monthly income. After meeting their expenditure, they would have a savings pool. And I would assume that every investor, either independently or sitting with his or her advisor, also has a plan in terms of how much of savings he or she should have and how much should get invested into mutual funds.
Right.
So when you look at a monthly savings pool, some part of that goes into mutual funds systematically every month. And that inculcates a sense of discipline, which is very, very important if you have to reach out to that goal of having a really big nest egg at the age of 60. So SIPs are truly very, very important as a mechanism to reach towards their goal in a very disciplined manner, while keeping all the pulls and pressures of the market and while keeping all your psychological biases at bay. Now comes the second interesting question. Every once in a while, all of us, bump into a lump sum kind of an amount which comes our way. And we basically, struggle to find out whether we should be investing it in one go, whether we should wait and stagger it over a few years. So, you see, we did a very interesting study at UTI. And we realized that there are two options that any investor has. A, let's say an investor wants to invest 10,000 every month. It amounts to 1,20,000 over the full year. And suppose the investor continues doing that year after year for let's say 10 years. The second option is, you don't do that. You basically have a lump sum. Let's say that lump sum is 1,20,000. Let's say that you are one of those characters who can look into the future and say, what's going to be the lowest point of the year? For this exercise, actually, since this exercise was done on a post-facto basis, we obviously knew what was the lowest point of the market in 2010, 11, 12, 13, and so on. So we had the advantage of that. And we basically made that investment of 1,20,000 at the lowest point for that year. Very theoretical. It's not going to happen. Like I said, unless until you do have a crystal ball, you can't do that. But just for the purpose of driving home the point, let's look at the outcome of this exercise. On one hand, SIPs, 10,000 every month over 10 years. Let's say it yields to a return of X% annualized after 10 years. On the other hand, take advantage of the lowest point of the market, invest 1,20,000 at that lowest point, keep doing that for 10 years. At the end of 10 years, what we realized was that the annualized return was just X plus 1%, give or take. Now that's the difference in terms of the final outcomes on an annualized basis over a very long period of time, like 10 years, between a disciplined investment or trying to catch the market at a particular valuation. So therefore, coming back to your question, monthly savings, continue doing SIP. If you do get a big providence and you do get a lump sum amount, don't wait. There's no point waiting. At best, if you don't feel comfortable, stagger it in 2 installments, but just get over it by investing it in the next 2, 3, 4 months. No point waiting for it.
Right.
Yeah, so that's the short message.
Thanks, Ajay. That was very insightful. In fact, we did a study on the reverse side and we ran some numbers, and this is purely statistical, where we just compared different time investment across different time periods, where investors who have such a lump sum available with them, either they can invest it over the next 12 months or they invest it at that very point in time. And interestingly, exactly like you pointed out, for the experiment that you guys did, we had very similar returns. We had very similar outcomes from that. In fact, there was no significant advantage of following either method, whether of investing by way of an SIP or investing by way of a lump sum. So I think it would be fair to conclude, using the information from both of these experiments, that you should invest when you have the money rather than having the money and then thinking when I should be investing.
Absolutely. I would agree with you.
Right. All right, Ajay, thank you so much. Thank you so much for being on the show and giving us your valuable time.
Always a pleasure, Neelabh. Thank you.